Welcome to Dhansetu. Today are going to discuss strategic wealth, the four-category mutual fund portfolio.
Let's say you have 50,000 rupees to invest every single month. You want to build long-term wealth, but immediately you hit a wall. Where exactly should that money go? The first rule is simple: time. If you need this cash in under 3 years, it belongs in debt or hybrid funds. But if you are parking this money for 3 years or more, equity mutual funds are the clear answer. Look at this decision tree. Once you select that long-term equity route, the path violently fractures into more than 20 different mutual fund categories. It is an absolute mess of options. Faced with this gridlock, investors usually make one of two mistakes. They either chase the highest possible historical yield, only to get shaken out by the first severe market drop, or they panic, hide their cash in overly safe assets, and slowly lose their purchasing power to inflation. We are going to cut through that noise. We can strip those 20-plus chaotic options down to a disciplined four-category architecture: large cap, flexi cap, mid cap, and small cap. True wealth creation doesn't come from randomly guessing the single highest performing fund each year. It comes from building a tailored four-part system designed specifically to keep you from panic selling when the market inevitably crashes. We start with large cap funds. These are the structural backbone of your portfolio, targeting the top 50 companies in the country to deliver a stable 10 to 12% average return. But buying into these massive companies introduces an immediate efficiency trade-off. You have to decide whether to pay premium fees to human managers to pick the stocks, or pay almost nothing to let an algorithm track the index automatically. This chart illustrates exactly why that decision matters. Over a 5-year period, a staggering 88% of actively managed large-cap funds fail to beat the baseline return of the passive index after fees. The math points clearly in one direction. For the large-cap portion of your wealth, passive Nifty 50 index funds are the only logical route. To find the right passive fund out of the dozens available, you only need to screen for two vital metrics: the expense ratio, which is what you pay, and the tracking error, which measures how perfectly the fund mimics the index. This quadrant chart maps out our exact screening filters. We draw a hard line at a tracking error of 0.03 and another at an expense ratio of 0.21. That bottom left quadrant is your optimal zone. Any fund outside of it is rejected. For the foundation of your portfolio, paying a human manager a premium fee practically guarantees underperformance. Low-cost, high-fidelity passive replication is the mathematically superior choice. Once the foundation is set, we have to look at the portfolio's growth drivers, the mid-cap and small-cap funds. The historical SIP data for these categories is massive. The top-performing funds here routinely deliver explosive annualized returns, stretching from 25 to 36%. But those yields demand a severe toll. To get them, you have to survive violent, unpredictable market turbulence that can rapidly erode your capital in a matter of days. If you allocate too much of your monthly SIP to these smaller companies, you guarantee terrifying portfolio drops during a bear market. That exact fear is the primary trigger that forces retail investors to abandon their strategy completely. Yet, letting that fear convince you to omit them entirely is just as damaging. You need their velocity to achieve long-term compounding. Small and mid-caps are the undisputed engines of wealth creation. They just require strict restraints, leashed entirely by your personal psychological breaking point. That brings us to our fourth and final category, the Flexi Cap mutual fund, which serves as the adaptable bridge in your portfolio. Under SEBI regulations, Flexi Cap managers hold a unique mechanical advantage. They are legally allowed to dynamically shift your money across large, mid, and small cap stocks, depending on real-time macroeconomic trends. This fluidity is the exact opposite of the rigid, locked-in nature of the passive index funds we established for your foundation. The trade-off here is control. By utilizing a flexi cap, you are surrendering your structural allocation and relying entirely on a human manager's ability to accurately read and time the market. But that surrender serves a distinct purpose. Flexi caps provide crucial, hands-off adaptability, acting as a structural shock absorber when market dominance rotates between the safety of large corporations and the velocity of smaller growth companies. Now we have our four distinct tools. The final step of portfolio construction is mapping those categories directly to your exact psychological breaking point. We measure this through your maximum acceptable drawdown. Simply put, how much cash can vanish from your screen before you panic and hit the sell button. First is the conservative optimizer. If seeing a 1 lakh balance drop by 10,000 rupees gives you sleepless nights, you belong in this group. You cap your acceptable loss at 10%. Second is the balanced pragmatist. This investor can comfortably stomach up to a 20% drawdown before feeling the urge to exit the market. Third is the aggressive accumulator. Temporary drops exceeding 20% don't faze this investor at all. They are focused purely on maximizing long-term yields. Be ruthlessly honest with yourself here. Allocating your money aggressively when you actually possess a conservative mindset is the single most common cause of long-term financial self-sabotage. This scorecard translates your risk profile into exact monthly percentages. For the conservative optimizer, we insulate the portfolio by putting 80% into large caps, 10% in Flexi, and capping mid and small caps at 5% each. For the balanced pragmatist, the second column blends structural safety with meaningful growth. We allocate 50% to large cap, 20% to Flexi, 20% to mid cap, and 10% to small cap. And for the aggressive accumulator, maximizing compounding, the final column slashes the large cap safety net down to 20%. Another 20% goes to Flexi, while mid and small caps take 30% each. Notice the structural shift. As your risk tolerance expands across the board, the stable large cap foundation intentionally shrinks to make room for volatility. Your job now is to lock in your self-diagnosis and commit rigidly to the blueprint that matches your psychology. A resilient, personalized system mapped to your actual behavior will always outperform the stressful cycle of chasing random top-performing funds. We fully covered the screening process for your large-cap index funds today. If you want a part 2 detailing the exact data metrics required to screen for the best mid, small, and flexi cap funds, let me know in the comments below.
Subscribe to Dhansetu and stay ahead in the world of finance, investing, and wealth creation.